Okay, well, so that's the view coming in from Alexander Redmond of CLSA. Ed Yardeni is with us, president at Yardeni Research. Ed, great to have you back on the program. Thank you for your time. Good to have you here. I mean, I think over the last 2-3 years, we've had, I think, 3 of these instances where we've talked about whether this is it with regards to China and the turn that and some of these measures that we're seeing. So we're at one of those moments again. The thing is, each of those rallies have been very large, between 40-50%. So actually, you can be in it and then without having to worry whether this is because the moves are so large if you get in reasonably early. Do you think it's one of those, Ed? What's your sense?
I think it is one of those. I think it's to a large extent a technical rally. There was a tremendous amount of bearishness before the government of China acted to provide a lot of stimulus. And so there's a lot of short covering, obviously, and then expectations that it's going to work. I'm skeptical because I think at the end of the day, what China needs to do is stimulate consumer spending. And I don't think it's going to be that easy. I don't think offering lower mortgage rates is necessarily going to bring Chinese buyers back into the real estate market. Maybe it'll stop prices from falling. But at the same time, I think they're still going to have a significant residual negative wealth effect in real estate. Maybe the stock market rally will provide some positive wealth effect, but again, the market's down substantially over the past few years. And then there's the whole geriatric demographic profile as a result of the one-child policy. So I'm not convinced that this is going to do what China needs to do, which is stimulate consumption, stimulate more births, more family formation. But it probably sets a floor for now, anyways.
Mr. Yardeni, hi, good morning. So,
morning.
What does this mean? What could it possibly mean for India, where investors anyway have been neutral? We're not even neutral. I mean, they've been underweight on this market. It's been a domestic-driven rally, and now you have these big moves out of China, the tactical move perhaps to that country. So, what should we expect? Some more foreign selling here, and then a shift in flows, or would it be possible anyway as investors get back into emerging market funds where, we have presence of both India and China?
Yeah, well, I think one of the key points here is that central banks, the major central banks, are pumping liquidity back into global financial markets. The U.S. cut the Fed funds rate by 50 basis points last week in the middle of the week. And by the end of the week, the Chinese were cutting their interest rates and reserve requirements. And so there's a lot of liquidity pouring back into the global financial markets. And that means that if China goes up, it doesn't mean that India has to go down. I think both markets could do well in a global melt-up situation. I think the Fed, by cutting 50 basis points in an economy that looks quite good, as a matter of fact, a lot of the numbers were revised higher for GDP and for personal savings on Friday. And so the U.S. economy looks pretty good, and you kind of scratch your head wondering, why is the Fed so rushing to lower interest rates here? Well, all that liquidity is going to create the potential for a melt-up. Look, I've been thinking the S&P 500 could hit 5,800 by the end of the year. Well, we might get there tomorrow or the next day, the way things have been going. And valuation multiples are awfully high. So I think we're in a melt-up situation on a global basis.
All right. Hi, Ed. Morning and good to see you. Ben, what does it mean for an Indian market, though? We have been big outperformers. We're not trading cheap. And suddenly you have the Chinese market coming back into play. And they are also going to deliver double-digit growth, but we are going to deliver high teens. The toss-up between the two in the near term, as you said, both could do well. But in the near term, do you think there'll be a tactical shift towards China?
Well, I think there's so much money sloshing around in the global financial markets that I think it's really conceivable that China might continue to rally here on the hopes that the stimulus will turn their economy around. And yet there'll be plenty of money left to continue to invest in India. So I don't think it's a zero-sum game. I think what we're seeing here is that central banks have basically brought back the everything rally. We're seeing stocks going up. We're seeing copper going up, gold going up, Bitcoin going up. So all that liquidity suggests risk on. And it suggests that central bankers are back to their old game of probably providing way too much liquidity.
All right, Ed, we leave it there. Thank you very much for your time. Great speaking with you. So I think the answer is too much money sloshing around, right? So that's lifting most things, most boats, and that is absolutely correct. Central banks have just about opened with rate cuts, and the Fed has done it, and China has done it, and perhaps others will follow as well. We'll take a